This is Andrew Jordan, and this is my final video on the concept of bringing in a key employee to be an owner in your business. In this video, we're going to talk about the tax implications. Now, there's a couple different scenarios we're going to go through here, but I think a lot of people are probably surprised at the idea that there might be tax implications of bringing in someone to be an owner. The reason for this is the clients I work with as a fractional CFO are businesses that are scaling past $1 million. And one of the things I say very often is what used to work for you when you were a lot smaller no longer works for you. You're no longer running a lemonade stand that can run fast and loose. You have enhanced banking requirements, enhanced accounting, enhanced tax requirements. As you do more and more complicated things, like going from a single owner business to a multiple owner business, that increases the complexities quite a bit. And you have something valuable and you have something at stake. So you got to make sure you do it right. Again, might be a surprise to you, there are absolutely tax implications about bringing in someone as an owner. And it has to do with how they come in as an owner. There's really three main options, although there's kind of a bonus fourth one we'll talk about at the end. The main ones we see, the kind of most obvious one is I'm going to have them buy into the company. Whether that's for $1 or that's $100,000, you have a transaction where you are the owner, let's say currently of 100%, and you're selling shares to them. I'm going to say shares, whether it's a partnership interest or a membership interest, if it's an LLC or an S corporation, like whatever the legal technical name is. I'm going to play fast and loose with this a little bit and just call them shares. Conceptually, that's kind of helpful for us because if you had Microsoft shares and you sold those, you know you'd be paying tax on the gain. Now, it might be long-term capital gain if you've held the business more than a year. So that's good news, but the bad news is it's potentially a tax hit that you're not expecting. If they're buying in for sort of fair market value, that might be a couple $100,000. You might need to have a business valuation formally done to come up with this value so that their 10%, you know what the buy-in should be, and that's what you're going to pay taxes on. If you think, hey, I've got a clever idea, I'm going to have them buy in for $1, just know that the IRS can recharacterize that. They can say, well, your business, 10% of your business is worth more than $1. Therefore, what we think you were actually doing, disguising as a sale what was really not a sale, what was really them earning this through their efforts. That's why you sold it to them for this ridiculous discount of $1. So cool, you don't have like any capital gains to worry about. You now have, if the IRS recharacterizes it, which they might well, they're going to recharacterize it as the way that's the most expensive for tax purposes. So let's talk about that next. If someone earns the shares and those shares are worth $100,000, then whether you hand them cash or you hand them shares worth $100,000, you have compensated them $100,000, which means it's compensation to them. They need to pay tax on it. You're going to also have to add it to their W-2. You're going to have to show it and you pay your employer rather, payroll taxes on it. So there's payroll taxes, there's income taxes. Most of those taxes, though, are paid by the key employee. In the first scenario, when you're selling it to them, most of the taxes are paid by you. But if you try and disguise it, you try and disguise what's really them earning it as a sale, do know that the IRS absolutely can recharacterize that no matter what legal papering you have with it and say, this isn't really a sale for some artificially low price that they came up with. It could be $1,000, it could be $10,000. If that's an artificially low price based on the value of your business, then they can recharacterize and say, yeah, really what was going on here is we think the business was worth $5 million, so 10% was worth $500,000. You are in violation because you didn't add that to their W-2. You got taxes and penalties. They've potentially got taxes and penalties. That's not good. So don't end up in that situation. Don't try and play that game with them. If it's a sale, make it a real sale for a real amount. If they're earning it, just know that, man, that is an expensive way. The employee has to pay tax, not you. So that's maybe some silver lining. But if they're not planning on that, they could become really unhappy. And also they might not have the income to pay the tax. Great. They're, richer. They have more wealth because you gave them 10% of your company and that's worth $100,000. But now they're going to have to pay $20,000 or whatever it is tax on that in real cash. And they don't have that real cash because you gave them stock. They can't pay their tax with that ownership percentage. So that's a factor to consider as well. You could end up with either you, if you're selling it, or them, if they're earning it, with some really big tax bills that you need to make sure you plan for. The third option, and this is a great option, but it has a limited application. It is for you to personally gift them shares. Now, every year this amount is indexed for inflation, so it goes up, but it's around $15,000 or $16,000. You can give them, say, $15,000 worth of cash or shares or whatever every year, tax-free. Again, the consideration here is if the IRS says, well, that's you really disguising compensation, they could recharacterize it back to wages, and then you've got taxes and potentially penalties and interest and all that kind of stuff. But potentially, you could gift them some shares. That could be good. But again, it's limited application because it's fairly small amounts. Unless you want to give them $15,000 a year, maybe for the next several years, or maybe your business is worth little enough that you can gift it to them and maybe do it over only 2 or 3 years because the value is fairly small. Be aware if you're a growing company, and most of the companies we work with are, your value of your company 3 years from now might be much higher than it is today. Often what we see is companies biting the bullet, doing a business valuation because they know that 10% of the company today is a whole lot less than 10% of the company next year or the year after. And you can argue for a lower valuation because it's a minority interest. If you could buy 10% of a car, it's worth less than the retail value of the car times 10%, right? Like, what good is part of a car? You don't have a controlling interest. A minority interest can have a discount applied to it fairly, and the IRS supports this because, well, you're not in control of anything, so it's not worth quite as much. And so you could potentially argue for a low enough valuation that you say, look, I'm just going to sell this, and I'm just going to take the capital gains hit and pay the tax and be done with it and move forward with it. That is much less scrambly and scrappy and do it by, your bootstraps kind of a way as you maybe used to do things when you were a lot smaller company. But I'm telling you, as you become bigger, you have more at stake and you become a much better target for the IRS. So you have to start thinking about these things, even if you would much rather not. Like, I would just rather change the percentage of ownership on the K1 where they magically have 10%, I have 90%, and we just go down the road. It's going to be fairly easy for the IRS to find and look for, well, is it reported on their W-2? Is it reported to you as capital gains? No, okay, this seems like a guy we should audit. I'm not saying they're sophisticated enough to do that today, but increasingly the IRS is starting to catch up on technologies and they'll be able to find these things, and it puts you just more at risk. And again, the more you have at stake and the bigger target you have, the more you want to make sure you do these things the right way. So before you have settled what you're going to do, talk to your CPA, talk to your lawyer, figure out how to best do the transaction, and know that's probably going to cost someone some tax to bring in another owner. In most cases, it will. Now, the fourth option I told you about is great because it doesn't have anyone paying tax in general, but it has like a big catch to it, and that is this. Generally, starting a new business is a tax-free transaction. Creating a business together generally is not taxable. And so if you didn't have things that are stuck in this business, like Department of Transportation numbers that wouldn't transfer or whatever that is hard, you could consider starting a whole new business and having them be an owner from the get-go. And that would generally, again, consult with your tax CPA. This is not tax advice for you. This is not legal advice for you. So there's my disclaimer, but it's generally tax-free. So if the tax bill is really unappealing to you and it's worth it, you might consider a new business. Again, I would say if you're talking about saving $20,000 in tax, it's probably not worth the hassle of changing over all your bank accounts and your contracts and all that kind of stuff to new business just to avoid that thing. But if you're talking about a huge tax burden, it's at least something to be aware of. So tax implications, my main takeaway for you here is it's not great, but you need a plan for it because at least then it's manageable. Managed pain is deal withable. Unmanaged and unplanned for and unexpected pain can really hurt you. So at least now you know, so you can plan for it. All right, so we've talked through several different avenues that you can go through to get to this end result you want of a key employee becoming an actual owner of your business along with you. And I talked through the different options, the different ways to go about this because I wanted to illustrate how they have different tax implications. Now what I want to tell you is the one that I like the most. Now, it doesn't always apply, and there's some things you have to maneuver through, but I like it the most whenever it can work because it's non-taxable to you and it's non-taxable to your employee. Now, again, I went through the other ones first because I need you to understand that if you don't dot your I's and cross your T's, you're now a big enough business where those numbers really have real repercussions. And if you don't do it the right way, the IRS can say, well, here's what we think you really did. And they've got you. And then you have a lot of taxes and also penalties and interest and all sorts of bad things. Here's the best scenario. You have your company issue more shares of itself to the key employee. So think about this. When in Walmart scenario, when Walmart issues shares of itself, it's not having taxable income when someone buys those. It's just issuing shares of its ownership. You can potentially do that as well with your company. Now, I'm not a lawyer, but my understanding here is that whether this is allowed or not, or how exactly it's allowed, can vary from state to state. But if it checks out with a lawyer who specializes in business things in your state, then this can be a really win-win for everyone, where it gets you what you want and no one's paying any taxes. That's the scenario we like whenever it's possible. And the key is to make sure you do things the right way. You have all the paper worded correctly so that that's the result you get. If you make a mistake and say you tell your lawyer you are selling shares, well, then you're selling shares and you have capital gain, and that's potentially a really big number. Versus if you have the company issue shares, and you're going to have a lawyer involved with this, most likely. They're going to have to probably notify the Secretary of State, probably jump through some other hoops, depending again on your state, to make sure everything is papered correctly and lines out to make you protected in case the IRS doesn't like this. Because of course they'd rather you pay more tax. So protect yourselves, do everything the right way, and know which of these scenarios you're wanting to try to do in your particular case. One additional flavor of this that we sometimes see that can be really powerful is, let's say your key employee doesn't have the $100,000 to buy the shares that you both want him to have or her to have. In that case, you can potentially have that key employee have a loan back to the company. So it looks like this. The company issues 100,000 of shares. This key employee now owes $100,000 back to the company. Again, if you're doing this, you got to have a loan document. You got to have interest at a stated rate. You got to actually have payments made eventually. So they can maybe use the distributions you give them, which you'd actually have to give them the distribution, have them deposit it. Then they can turn around and write a check potentially to start making payments against that debt, which would include interest required by the IRS too. A number of hoops to jump through, a number of things to be aware of, but we're talking potentially tens or even hundreds of thousands of dollars of tax savings, so it's well worth it. But the key is make sure you plan out ahead of time and go through everything the right way. So there's several scenarios I've lined out here of what happens if you sell stock, if you issue it for services, if the company issues stock. There's a lot of different scenarios, and the end result is basically the same in all of them, but the avenue you choose to get there can have drastically different tax results. So I strongly encourage you, as I have through this whole video, talk to a professional about this, someone who is not just a generalist, but really specializes in this kind of scenario, who can give you advice through it and protect you from paying potentially tons of tax down the road. I hope this video has been helpful. If you have any questions, please reach out. We work with businesses as they're scaling and have exactly these kind of situations and these kind of problems. Would love to talk about them with you.